In this chapter, I want to introduce financial statements. The first thing we'll look at is we'll talk a little bit about personal financial statements, but then we'll also get into some basic descriptions of the financial statements from a corporate point of view, or a business point of view at least. So if you think about financial statements, there are two primary statements for individuals, right? Many of these you may have to provide if you're trying to start a business or maybe trying to get some kind of a loan from a bank. But essentially what we need is a statement of financial position. This essentially is a net worth statement. And if you look at the combination of the assets here, or the combination of the terms, the line items, essentially it's a balance statement. So you need a balance sheet that shows your current net worth, right? What are you as an individual worth? And we'll discuss this when we get to the next slide, or the next slides up. You also have to have some kind of a personal cash flow statement. Now, I've created a couple of worksheets that will assist in creating these statements that I believe are fairly intuitive, but provide an awful lot of information about a person's current financial condition. So when we think about income, a couple things we need to get in line here, right, is we need to understand what are all the sources of income that we have, right? Wages, tips, all right, is there any overtime? What kind of securities compensation do we receive? But in addition, is there income that comes from a business, from a partnership? We need to understand the differences between fixed expenses and variable expenses. When we think about fixed expenses, it's a little bit different with a person. These are the costs that have to be paid every single month. So they are things like rent, mortgages, right? Insurance, utilities, etc. These are all choices of contracts that we've created. The variable side refers a little bit more to something referred to as disposable income, right? After you've paid all the fixed expenses, how much money is left off for what I'd like to refer to as the quality of life issues, right? The things that you spend money on that make you probably the happiest, that are basic needs, like groceries, right? Clothing, all right? But how do these things relate to each other? So the next two slides are going to be an illustration of personal financial statements and how they work together. So the first statement is a statement of net worth. And essentially what we need to do is we need to categorize the assets of investors, of individuals. If you look at the asset side, there are some categories that we can divide our assets into. So we can have liquid assets, cash, savings accounts, money market accounts, right? These are all very short-term things that can be turned into cash, or they are cash, very quickly. The next thing we have to do is we need to add investment kinds of assets. But these are short-term things. So CDs, treasury bills if we have any other kind of a short-term asset that is not strictly what you would refer to as being cash. Long-term investments, obviously, are all those other things, right? Stocks, bonds, mutual funds. How much money do we have already in IRA accounts or in corporate retirement accounts? So I've tried to give us several different places so we can identify, where the money actually is sitting for a company. Do you have any other assets, other investments? Is there business? Partnerships? Do you have any kind of a real estate investment? Those values would go in here. And then at the end, we have our personal assets, right? What's the market value of your home, your cars? How much personal property do you have? I have also an other thing here, right? So again, we can identify here not only how much we have, but we can also then identify the percentages. As you can see here, 94% of this person's assets are tied up in personal assets, which is probably the way it should be, especially when you're young. However, we would expect this to maybe change over time as we invest more and more money in pension funds, save some money, etc. On the right-hand side, we have the liability section, which is divided into consumer debt, current bills, credit cards, installment loans, any other kind of debt that you can think of. And then we have what I refer to as the more longer term debt, right? Do you have a mortgage? Is there a second mortgage? Have you taken any life insurance loans out? Student loans? Any loans against your retirement accounts? So we have identified these longer term components, if you will, of the financing of this family. So in the end, the short-term debt's $13,400, the long-term debt's $1,000, so total debt is $113,400, which then means if we had $188,900 in assets, if you subtract $113,400, the net worth of this family is $76,500. What I would like to say is the importance of this number. These numbers are obviously important. They are a reflection of where we are today. But net worth is the number that that investors, that individuals need to focus on. That's the number that you need to grow. A good definition of net worth is after you have sold all of your assets and you have paid off all of your debts, this is the amount of money that's left over for you to live on for the rest of your life. So you can see as retirement accounts grow, your net worth should grow. As value of your home increases and the mortgage decreases, net worth should grow. So our overall goal in investing for the future is to try to find ways to get net worth to increase. So how can we do that? Well, we need to do that by understanding a little bit about cash, right? We need to ultimately develop some form of an income statement so that we can show how our money is being spent on either a monthly or an annual basis. So this particular cash management statement is devised on an annual basis. So we have the salaries are listed under cash inflows. And again, you can see there are a variety of opportunities for different kinds of money to come into the family. So they have roughly $75,000 comes into the family. On the tax side, all the different taxes are listed. So they have $14,658 is the taxes that they pay. We have the insurance cash flows that this family pays for. So it's $1,350 is the insurance that they pay for. That sounds a little bit on the low side, but we're only talking about homeowners and auto. There's no life insurance here. That could be a bad problem, right? There's also no money that goes in that represents the cash flows from the company goes in from healthcare. If it comes right out of your paycheck, it's probably already included up here somewhere, but we might want to incorporate it down here. Then we have the debt cash flow. We have some standard things that people might have. And then, of course, we have some opportunities to add some extra kinds of debt. So in the end, we've looked at what? Here's cash inflows, here's the taxes, insurance, the debt cash flows of the company. We haven't talked yet about savings. And as you can see here, this family has nothing going into any savings. There's no emergency fund, no personal savings, and probably what's even worse is there's no retirement savings. So if you're looking at this individual, or if this would be you, you'd say, gee, I really need to start thinking about retirement. So what we end up with, as you sum these, right, you take the cash inflows and you subtract out all the cash outflows identified in these four categories. What's left is what is referred to as living expenses. This is the money left over. As I mentioned a little bit earlier, this is the money that's left over to cover quality of life issues, right? So what are those things? And frequently people get a little bit squirrely about budgeting because they think a budget is something that you write down and something that you need discipline, you have to follow. I kind of look at it a little bit differently. I like to think about budgeting as being something that's done after the fact, not prior to the fact. After the fact, what we want to do is we want to understand where we have spent our money. We need a schedule of where those expenses happen. So in this case, do we have any expenses that go towards housing? Now, if you're renting, you need to have rent in here. But if you own a home, you have a mortgage. What are some family expenses? Transportation expenses, charitable giving types of arrangements you may have. There's a whole section on leisure. Again, we want to understand how much money is being spent on this, what really are the quality of life issues. The things that make you happiest are these things under the leisure category. So we want to understand of the choices we're making, how much money is actually being spent in that category. We ultimately then will get some summations. We'll get some values for these, right? So here's the cash flows. This all comes from previous pages, right? The discretionary income then is $75,000. You subtract all these cash outflows from the end. That leaves us then with discretionary income of $42,000. So if you divide that out, right, it says, look, in the end, you should have a fair amount of money left over in your checking account. So you really want to watch and say, well, where can I change my expenses so that I can get more discretionary income? Because discretionary income is the money that we have that can be used for paying down our debt obligations, can be used for investing in things that ultimately will have growth or increase the value of our net worth. So again, as a little guide, I think it's kind of important to get down in paper, where you've spent your money. Now, we may need to make changes. If discretionary income is too low, if there's not enough money being spent on retirement or savings, if there's so much debt that it's constraining our month-to-month living arrangements, then we need to figure out, how can I change the things that I'm doing? Immediately, these are the things that you can change. The long-term things, the things on the other part of this financial statement then, are those things that are more difficult to change. We have to pay off the debt to relieve that cash flow. But some of these choices we can just make and just adjust our lifestyle a little bit, and hopefully that will help our net worth. So moving on, let's just continue some basic analysis or discussion of financial statements. The first financial statement we can talk about for a company is the balance sheet. And there's a very simple equation. The total assets of the company equal the total liabilities of the company plus owner equity or net worth. So from a sole proprietor's position, the net worth is referred to as owner's equity. For a partnership, it's called partner's equity. For a corporation, it's called stockholders' equity. The balance sheet doesn't change based on the kind of entity that we're looking at, whether it's an individual or a different kind of a business form. So here we have a basic statement that shows owner's equity. This is the sole proprietorship. Shows at the bottom we have total liabilities of total liabilities on an equity 421. That's the same as total assets. But really what we want to look at here is the owner's equity piece. So how does this change based on the kind of company? So if we look at a partnership, we would see that partner's equity is then divided based on the partners of the company. And indeed, if we were looking at a corporation, we would see that ultimately it is changed by the kind of corporation. It would be stockholder equity. The income statement then is just a picture of how we ran our business this year. What kind of decisions do we make, and how did they influence the cash flow of the company? So obviously we have some sales, we have cost of goods sold if we're selling products. So we end up with gross profit. We'll talk about these statements in more detail in later videos. Operating expenses, these are the expenses of running the company. That gives us with something called operating income. So of the 348,000 net sales, we ended up with $74,000 left over from running our business. Now that's not cash, that's an accounting statement. That's an accounting number. After this, there are two other things that have to be accounted for, if you will. We need to account for tax or interest. How did we finance the company? So this particular business, which is a sole proprietor, this is that Tom Jones company, they had $10,000 in interest, so the net income is $64,000. Now here's the difference between a sole proprietorship and everything else, the partnerships and the corporations. The $64,000 is distributed to the owner. It's their salary, if you will, for the year. But what about for a company that's maybe a shareholder, a corporation? That's $64,000. We have to pay taxes. Now we have $53,000 left over. And if this company had 100,000 shares outstanding, then the earnings per share for this company is 53 cents per share. Now we'll talk about these as we go through the statements in more detail. But essentially, when you buy a company, one of the things you're entitled to is the profits of the company. So this 53 cents belongs to you, the shareholder. There is another financial statement that's very important. It's called the statement of cash flows. Essentially, what this statement shows us, it really breaks management's decision making into three categories. Managers have to decide how to operate the company. Whatever business you're in, you need to make sure that you can make money from the business. If you're in a retail store selling clothing, right, you have to be able to make cash, generate more cash coming in than cash going out from those operations, from that business. Cash flows from investing activities are another decision altogether, right? Maybe you need to replace assets. Maybe you want to expand operations. Maybe you want to sell some assets. So those decisions about changing the asset base to run this business are a whole set of questions, another set of questions that is really nice in the statement because it identifies what those things were. And in the end, we also have to answer questions about financing. How did we pay for running this business for the year? Where did the cash come from to help us by buying assets or selling assets? And how did we get that money back to our owners, to our creditors? So there's a cash flows from financing activities. In the end, an increase in cash here basically shows that what? More money came into the company than went out. Now we want to analyze this over time to see how the company is developing its strategies for generating cash and then utilizing that cash to get money back to its owners. There is a definition of cash flow. It's called free cash flow. And the definition isn't necessarily in this textbook, but essentially this is how it works. This is the cash that's left over after all the expenses of running the business have been paid for. All the activities of short-term management have been paid for. All of the activities of buying and selling long-term assets have been accounted for. All the business has been completed for the year. This is the money that's left over to pay investors. So we can pay dividends, we can buy back stock, we could pay interest expense, we could buy back debt. We could put this money aside in short-term investing. Maybe we want to consider buying some other assets, some other investments, another company. But this is a strategy for moving. If you have extra money left over, what do you now do with that extra money? And here's a short picture of this. You can see that $49,000 was generated from running the business. $150,000 was spent by acquiring plant assets. $150,000 was also acquired from financing. And you can see here we issued some preferred stock, we issued common stock, we borrowed some more money, and of course we paid off some of our debt obligations. So the net was $150,000. So the net increase in cash, $49,000 minus $150 plus $150, cash increased by $49,000. We started off with $3,000. So in our checking account, we should have $52,000 left over for this company. Now there are 3 more videos coming. Each one of these videos gets into one of these financial statements in a lot more detail.